Hello. Today we're going to take a look at long-term investments, and to do that fairly we're going to use the compounded annual growth rate, which I discussed in another video. That's really the only fair way to compare investments over time. So let's just get started. We're going to take a look at comparing investments over a 30 and 40 year period. So for the 30-year period we're going to go back to January of 1990 and go to the end of 2019, and for a 40-year period the beginning of 1980, and of course go to the end of 2019. So notice here for silver, this is using exact values. So for silver over a 30-year period it had a compounded annual growth rate of 4.19%. For a 40-year period, notice it was negative. It was a 1.99%, but that was negative. That's because silver at the beginning of 1980 was around $39 an ounce, and of course at the end of 2019 it was still below $18 an ounce. So over a 40-year period it actually had a negative compounded annual growth rate. Gold over the last 30 years has had an average annual growth rate of 4.56%, and over a 40-year period 2.53%. Now silver and gold, we have exact data because that's traded daily. Now we're going to get in some information where we have to use some the best estimates that we can. So the median new home values. This is U.S. Census data. Now the difficult thing here is we're not always comparing apples to apples because homes keep getting bigger. For example, 40 years ago, the average typical median home size was around 1,600 square feet. 30 years ago it was about 1,800 square feet. And today it's around 2,400 square feet. So when we're comparing new home values today with what the new home values were 40 years ago, we're not really comparing the exact same size house. But having said that, the median new home value, if we use governmental data over the last 30 years, has had a compounded annual growth rate of 3.2%. For a 40-year period, 4.16%. Okay. Now for each of these here, we're only looking at the asset value over time. Naturally, some people think, well, I could rent my house or I could buy a rental property. That's true. Now, you also got to remember, of course, you can bring in rent. You also have maybe some additional headaches putting up with tenants. You have property tax, insurance, upkeep, things like that. Okay, so that's a different issue. We're only again looking at the asset value itself here. Median home value, notice I'm missing the word new here because here this is using what's called existing homes. The government doesn't really collect data on that. So this is data from Robert Schiller and the Federal Housing Finance Agency. A combination of those things, and again the best estimate over a 30-year period 3.5%, over a 40-year period 4.08%. Now what about farmland? Well, over the 30-year period it's actually better, but notice it's not over a 40-year period. Why would that be? Well, in the 1980s farmland did not perform well. Okay, over about a 3-year period farmland went down over 30%. So that decade was not good for the farmland. This is using Iowa farmland. This is data from Iowa State University, the extension there, and using their data, this is a statewide average of farmland. Naturally, farmland varies from county to county, but over a 30-year period, it averaged 6.22%, and over a 40-year period, 3.25%. Now, all of these are good. However, we have to remember that the inflation rate over the past 40 years has averaged approximately about 3%. So notice most of these is just keeping up with inflation. Or we could say that the majority of the gains was just due to inflation, not necessarily the asset itself going up in value. Now what about the S&P 500? The S&P 500 really is just the benchmark most people use when they talk about the stock market. It's really just a basket of the larger 500 companies of the United States. Now, over the last 30 years, it had 9.96% rate of return. This is with dividends that the companies pay you. And over the last 40 years, 11.84%. Notice here, let's take the last 30 years. This includes the dot-com bubble in 2001, 2002, where the stock market went down. Okay, and it also includes the housing crisis of 2008 and 9. Okay, so two volatile periods, and it still averaged approximately 10% rate of return. Now, bonds are a little bit more complicated. Notice with stocks, we didn't pick, the best stocks or anything. We picked a broad swath of the stock market, and we used the S&P 500. We'll do something similar with bonds because, of course, there's foreign bonds and domestic bonds and municipal bonds and corporate bonds and T-bills and all different kinds of what might be referred to as fixed assets. So over a long period of time, okay, they have averaged somewhere between 3.5% and 5% rate of return, depending on which period we pick. Okay, so we'll just kind of leave it at that. That's kind of the best estimate we can do. Now remember, I'm using a compounded annual growth rate, not what is referred to as the average rate of return, and that's different. If somebody's quoting the average rate of return, which typically if you're looking at bond values and stuff, the average rate of return is an inflated number. Okay, it's not the same as the compounded annual growth rate. Now, what would a one-time $10,000 investment do over time? Well, silver, $10,000 invested 30 years ago, by the end of 2019 would have grown into approximately $34,000. $10,000 invested 40 years ago, actually remember that was a negative rate of return, so you'd end up with less. Okay, so certainly not a very good 40-year investment with silver. Gold, 30 years ago, if we would have invested $10,000, it would be worth approximately $38,000 today. If we would have invested $10,000 40 years ago, it would be worth about $27,000. Median new home. So basically, for every $10,000 invested in real estate, 30 years ago would be worth about 2.5 times that much, or about $25,000. Okay, $10,000 invested 40 years ago, approximately $51,000. Again, existing homes, pretty much the same. Farmland. Okay, so notice $10,000 invested into farmland would now be worth $61,000. So over 30 years, pretty good. Over a 40-year period, notice it didn't grow as much over 40 years. Again, that's because of the decade through the 80s where farmland did not perform well at all. But what about $10,000 invested into the stock market? If we would have invested $10,000 into the stock market or the S&P 500 30 years ago, we'd have $172,000 rather than any of these values. If we would invest $10,000 40 years ago, it'd be worth approximately $880,000. Now, naturally, we can't predict the future, okay? But we are looking over the last 30 years and actually the last 40 years. So two different snapshots of what has happened over the last few decades. And we're using that to kind of predict the future. But you can see, regardless of what period we use, nothing is coming close to the stock market. The reason a lot of people feel that homes are a good investment is because if somebody does buy a home, for them it's typically really a forced savings plan. They're forced to make those house payments. As Americans, we are not very good at saving money, let alone investing it. So at least if somebody buys a house and they're making their home payments, it's a forced savings plan for them, because typically that's really the only savings they're going to create. So it ends up being a really good investment for most people. But as if just truly looking at the assets, nothing is comparing with the stock market. Now, I understand that a lot of people are kind of fearful of the stock market. We can buy the S&P 500 extremely easy. We can just go through a discount broker. We don't really have any fees. It's the easiest thing here really to do. And notice that some people might think, well, farmland can generate crops and produce income in addition to what is going up in value. Well, that's true too, but you can rent farmland and be a farmer that way also, and farmland typically rents for somewhere around 3% of its overall value. So that's really what it's worth to own it. Remember also that property tax, insurance, maybe a little bit of upkeep can be at least a point and a half or close to 2%. Also, if you're going to operate it yourself, you need machinery, you need investment in labor and things like that. So that gets a little bit more complicated. Again, we're only looking at the asset itself. Now, what about fear and volatility? Well, we'll look at that in just a moment, but again, this is just a nice little graph of what the graph would look like if it was a smooth curve. So if something was truly growing at that compounded annual growth rate consistently year after year, notice a $10,000 investment over 30 years. This would be the graph of gold. This is where it ended up. The green would be the graph of farmland. This is where it ended up. And of course, the S&P 500, much better. Now, naturally, nothing really grows in a nice smooth curve. There's volatility. So what about volatility? Well, standard deviation is really kind of a measure of volatility and the frequency of volatility. So when we're looking at these assets, again, I didn't pick any particular period of the 30 or 40 year, but just on an average. Silver, notice silver, gold, and the stocks all have relatively close to the same type of volatility. Okay, gold in the last decade had a period of time where it dropped 30%. Okay, we already talked about farmland in the 80s dropped over 30% over about a 3-year period. We know what the stock market did during the housing crisis and the dot-com bubble and so forth. So everything goes up and down in value. Nothing is in a smooth curve. All of these are volatile. However, housing, farmland, and bonds are the least volatile. And that is exactly why people recommend having a diverse portfolio, because if we have a mixture of stocks and bonds, then that tends to kind of take away some of that volatility. However, bonds don't perform as well over a long period of time. So what you're really doing is kind of taking away short-term risk, but you're hurting your long-term performance. Now let's look at a true graph of the S&P 500. This is going back to 1980. Notice it's not a nice smooth curve. Nothing is. And this curve is going to have a few more ups and downs than something like bonds or farmland. Okay? They will also be volatile, but not quite this much. Notice this little part right here was what was called the dot-com bubble shortly after the year 2000. 2001, 2002, the stock market went down. Here's the housing crisis. Okay, starting towards the end of 2008, and then of course it goes down for a couple years, approximately. Now, people can get rather emotional during these periods of time. Emotions can cause us to make some poor decisions. You know, it gets kind of painful, and then people kind of panic, and then sometimes they sell towards the bottom. If you're a long-term investor, you really should not care about volatility. The worst thing you can do is really be checking the market during these times. In fact, these are really opportunities. If you were investing every month, let's say you're having some money taken out of your paycheck every month and putting into the stock market, okay, this is a wonderful opportunity for you, because in a way, you're kind of gives you an opportunity to buy it on sale for a while. And over a long period of time, that's really going to help your overall performance. Now, I want you to focus in on this little part right here. There's a little drop right there. And that was in 1987. Let's focus in on that graph just a bit. I'm going to zoom in on that part, because this is the single biggest one-day drop in the market. In one day, the market dropped about 23% approximately. That could be emotional. Okay? And cause people to rather kind of panic. Okay, so this is this is what people really kind of fear when they talk about stocks. Well, it's risky or so forth. But remember, if you are an investor, you should always be thinking of a longer term. Okay, any money that you may need to use or have access to in the next 2, 3, 5 years probably really shouldn't be invested. Okay, because that's the short term, and then you're kind of speculating. Investment should really be thought of as a long-term idea. So here, the biggest single day drop in the stock market. Now, let's go back to this graph. Here it is right here when we zoom back and look at a longer period of time. Notice again, this is going back to 1980. It's really an insignificant little blip. It's meaningless. And yet, during that day or during that week or that month, people were really panicked. Again, an investment should be thought of as a longer term venture. When we zoom out in a few years, okay, the dot-com bubble and the housing crisis is going to look pretty similar to this. It's really going to be an insignificant occurrence in the stock market over a longer period of time. In fact, if people would have just not worried about the volatility and continue buying month after month after month, this actually was a wonderful opportunity for people. Okay, so the worst thing we can do is panic. Okay, we need to control our emotions. There should never be any emotions involved when thinking about investment. Okay, so over a long period of time, if you want to maximize your performance, you want to have the majority of your assets in stocks, or the easiest thing really is to buy the S&P 500. It's the same thing Warren Buffett recommends. There's a reason he recommends for a long period of time, he recommends 90% of your portfolio in stocks or the S&P 500 and only 10% in bonds. The same advice he has left for the portfolio that he's leaving for his wife when he passes away. Okay, so now, naturally, if you are closer to retirement, we certainly should not have all of our money in stocks. Okay, any money, again, that you may need in the next 3 to 5, 6 years should not be in stocks really, because we could go through one of these volatile periods and you don't want to be in the position where you would have to sell. Okay, so again, long-term investment, if you're a long ways from retirement, nothing really compares to having most of your money in stocks. And the easiest thing you can purchase is just a low-cost ETF for the S&P 500. So hopefully you found this helpful, and I'll see you next time.